Found some difficult market conditions. Recession, not your baseline case.
Yeah, we still don't expect a global recession is a base case scenario because the emerging market growth is going to provide support for the global economy, but we expect very sluggish economic growth in the Eurozone and the US, and this will underpin earnings risk in the market, and this explains the sharp price movement in the equity market. But I think current valuation have already priced in a recession, although the market may not have priced in a full-fledged financial crisis.
Okay, so you said the market's already priced in a recession. Can you put the odds to a recession? We were talking to BlackRock's head of iShares strategy, at least. He says the possibility is 2 in 5.
Okay. We expect the Eurozone sovereign debt crisis will eventually muddle through with a 70% probability. So this underpins our base case scenario of a continual global economic expansion. So we don't expect a global recession, which we believe is a low probability event, unless we see more significant global financial market dislocation and a full-blown banking crisis.
Now, does your baseline case include either disorderly or orderly default in Greece?
Oh, we factor in an orderly debt restructuring of Greece, but with the possibility of a significant haircut.
Okay, so what about this reaction in the markets? You know, some are saying that we're not going to hit bottom for some time. What do you think we might see the end of this selling?
I think October will remain a very difficult month because we are not going to see the final completion of the EFSF ratification until the 25th of October. And there's still ongoing debate regarding whether the rescue fund can have leveraging in order to increase its firepower. This debate is going to last for several more weeks.
Several more weeks, okay. But when do you think we might hit bottom here in terms of declines we're seeing in the markets?
Okay. At Credit Suisse, we have our risk appetite index, which have dropped to historic low level. So based on historical data, normally when we see the risk appetite index hitting an all-time low, we are moving quite close to the bottom of the market correction, but it doesn't mean that we will see immediate recovery in risky assets.
Okay, so given the risk on the markets right now and the sell-off that we're seeing, where do you run for safety? Some are talking about getting to fixed income like bonds and favoring cash at this point. What are you saying to your clients?
Yeah, at the moment, even gold suffered from significant correction in recent weeks. In fact, there are very few genuine safe haven in the financial market when investors hurry to liquidate their long position, trying to stay in cash, and that's why the US dollar is expected to retain strength in the near term. So what we advise clients to do is to stick to a very defensive, high-quality core investment portfolio.
High yielding,
and need to,
dividend plays.
We will focus on high-quality dividend stock, and we also like high-quality issuer on the fixed income side, and we still see investment opportunities in gold, but do prepare for some more volatility in the coming weeks. But gold, after the recent sharp sell-off, valuation look more attractive.
I got to point out to our viewers quickly that your topics in the dividend space are all banks. We're seeing ANZ, BOC Hong Kong, ICBC is included as well. That's very interesting that you want to get into
banks are part of the key stock pick within our top 25 high-yielding stock basket. But we also recommend a number of high-yield play in the non-bank sector. But just talking about the high-yielding banks that we recommend to clients, we selectively pick those banking counter which would be most resilient to weather
Okay.
the slowdown in the advanced economy because they are mainly driven by domestic growth in the region.
Fine. Let's talk about these valuations. I mean, some are saying this is liquidation turning into capitulation, and these valuations are pretty much ridiculous. What are you seeing in terms of just the price action that we're seeing on the markets?
Yeah, we are seeing increasing signs of a final foreigner capitulation in Asia on the back of the global de-risking. And when we analyze the valuation level of the Asian market in terms of price to book, we are already back to the year 2008 level at 1.5 times, and this reflects market expectation for a global recession.
Right.
And currently market anticipates more than 30% downgrade in Asian corporate earnings. That I think seems over pessimistic based on the underlying economic performance.
Yeah.
So I think we are getting close to the bottom of the market, but the critical catalyst to support a sustained recovery in the Asian market would hinge on the development in the sovereign debt crisis.
How do we know when we hit bottom? What are the signs?
Okay, we would look at the valuation, which reflect how much bad news has already been priced in. Although it's now many investors don't believe in PE ratio as they have no confidence in the earnings outlook. But if we measure the price to book multiples, at least we get a more reliable indicator to show how deep the market have already priced in a decline in earnings.
So in these times, Fan, wouldn't you say that it's time for maybe the central banks to step in? We have this interest rate decision from Australia later on. Some are saying, well, all economists that we surveyed expect them to stay on hold this time around, but some are saying in the first quarter they're going to have to cut at some point. Do you think there needs to be some sort of help, some stimulus coming from central banks across the Asia-Pac right now?
Yeah. If we see further deterioration in the global growth outlook, I rule out the possibility that Asian central bank will take some stimulus measures in terms of physical stimulus or even monetary easing towards the end of the year. At the moment, if we analyze the macroeconomic data in Asia, the underlying economic performance still remains relatively resilient. The key risk is on the export growth outlook, and this is mainly driven by the sharp deceleration in U.S. and European growth.
Right.
So if the Eurozone debt crisis sees further deterioration, that will underpin the possibility of more decisive easing action in Asia towards the end of the year.
So if exports are at risk, how risky is China right now of a hard landing? Because some are hoping they'll come to the rescue this time, considering developed and Western nations are suffering their own problems. So what do you think of China's risk right now?
So far, we haven't seen serious risk of China hard landing based on the latest PMI and the key economic indicators released in China. I think investors are more concerned about the development of the trust financing and the informal lending problems in China more than the growth in the industrial activities. And China has already rebalanced its economic growth model. Net export actually contribute to a tiny portion of the GDP growth.
So it sounds like you're still bullish on China then.
I won't say that I'm bullish, but I think with the current depressed valuation, the market has already factored in very bearish expectations on China growth. And when we look at the real data to show the strength in the domestic demand and underlying economy, I think there are investment opportunities when risk appetite start to normalize.
Thanks for coming along. And just going to continue the conversation that we were having, Susan was having with you. But we've got this report from Goldman Sachs that's come through a short while ago. I mean, what are they calling a recession for Germany and France?
Yeah, Germany and France, and they're also cutting back their global growth forecast as well for the year, looking at the world to expand maybe 3.8%. Is that pretty much in line with Credit Suisse, or? Okay,
we also see bigger downside risk in the European economic growth outlook. We think we still see limited risk to have a global recession, mainly because of the relatively resilient performance
Yeah.
of emerging market economies, but the Eurozone is going to see more significant downside risk.
Right.
But we believe the U.S. is likely to see a sluggish growth scenario in 2012.
Right. But does that mean a German and French recession, though?
Currently, our house forecast still expect a modest growth for Germany and France next year. So it all depends on the development of the Eurozone debt crisis in the next few weeks, whether European policymakers can take decisive actions to stabilize the financial market.
Asia, excluding Japan, faces a downside risk of 10 to 15%, Goldman says. Is that bearish?
In GDP growth or?
Stocks.
Okay, I think
Asia, excluding
highlight
Japanese
that.
stocks.
Okay, in the very short term, I do expect further downside risk, mainly because of global risk reduction, not because of substantial deterioration in economic fundamental. Given that the Asian market are high beta, emerging market, so we have started to see intensifying fund redemption in the last 2 weeks, and given that the final ratification of the European Financial Stability Fund will take some more weeks to complete, and this will underpin further volatility in the Asian market.
Going with the Asia story, it just fascinates me looking at the third quarter figures,
Yeah.
banks absolutely being pummeled, being hit so hard, property stocks, and then yesterday, of course, casino stocks. How would you interpret that as regards the Chinese consumer, the Chinese market, Chinese sentiment, saying we're actually worried about our own situation?
What are we pricing in here, basically?
It isn't just about Greece or US, it's actually about China as well. What's the concern here?
Okay, to be more specific about the sell-off in China equities, is more related to investor concern about the problem related to informal lending activities and
in China,
entrusted financing activities in China.
It's quite a big concern when the stocks have been hit so hard, isn't it?
Because we are in an extreme risk reduction phase when investors are reluctant to take on any risk, and with the uncertainty about the exact scope and size of the illegal lending, in fact, it's informal lending, and the government start to take more actions to investigate or whether there's improper practice in these informal lending activities. So this caused concern among investors, although banks actually don't have direct exposure to this informal lending. They act as intermediaries, but the market get a bit concerned about the ripple effect
What I want
of
to
the problem.
get to is, what is it actually pricing in, though? I mean, the falls that we've seen for the Hang Seng, which is acting as a proxy for China, what is it pricing in right now? Because, I mean, it seemed with the declines that we had, 4% the other day, we had lowest level in, the worst quarter in a decade. I mean, is it pricing in a recession in
Is it a fair sell-off as well?
In fact, the market is starting to price in a hard landing in the Chinese economy, not just earnings downgrade, given that investor wants to see a better clarity about the credit-related problems in the China market, and even those the Chinese bank do not have direct exposure to this trust financing and informal lending. However, investors start to get concerned that whether the informal lending activities would have a broader economic impact that will drag the Chinese economy into a hard landing, and that caused panic sell-off. And yesterday, short selling is the main driver for the market correction in Hong Kong.
And we had that Todd Martin report, didn't we, from Societe Generale, saying that the market here is really ready for a real short squeeze. So we could see a big bounce, couldn't we?
Well, considering on the shorts that are put on. But he says right now it's a run on the stock markets by the hedge funds, who maybe, since they can't short anywhere, the financial shares in restricted economies, right, like France, like Italy, maybe they're coming here in the Asia-Pacific to short.
And that's why there have been some voice suggesting authorities in Asia even to consider putting ban on short selling activities, but I believe the Hong Kong government would be reluctant to take intervention measures to limit the
What level do we
trading.
get at, though, before these have to be unwound and we get that short squeeze and that bounce back up?
I think risk appetite is the key driver for this short squeeze, because extreme safe haven flow and extreme de-risking is driving all these emotional trading activities.
Do you think, okay, you called it emotion, do you think the market sell-off is, I mean, do you agree that there could be a hard landing? Is it reasonable to see this reaction?
Okay. At this point...
Also is it time maybe to buy into the low valuations and make money out of this, or is it safe to avoid banks altogether?
This is a very good question. I think at this point we haven't seen the evidence that these significant increase in informal lending activities will result in widespread default of Chinese company, but that underpins the potential risk of instability in the financial system. But the price action actually reflect a hard landing.
Can I cap off this discussion with, I think, the freakiest factoid of the day, which is how the S&P 500 closed? If we can have the producers bring up the S&P 500 close, you know, 1099.23, right to the decimal point. That was exactly where the S&P closed on October 3rd in 2008. So 3 years. It took 3 years to close off at the same. Those are the futures that we're showing you. Yeah. But anyways, you can take my word for it. It closed at 1099. Yeah. But so
exactly
we're saying isn't this an omen that maybe we're going to head back?
It's just maybe a coincidence.
Back down, maybe. I don't know. That's what we're saying. Can it be a coincidence right down to the decimal point? That's
it depends if you're superstitious, really, doesn't it?
I think it's a very creepy place.
I think it's just pure coincidence. That's all it is.
Spooky, I tell you.
Yeah. Well. Okay.
Definitely interesting. The exact decimal point.
Yeah, that's just remarkable, though. That bit is remarkable. Okay.
All right.
Time will tell.
Cheuk Wan, there you go, 1099.23. That might be the witching number on the markets. We could go lower from here. Thank you, Cheuk Wan of Credit Suisse Private Banking.